Welcome back. In our top business story, rising government debt levels and inflationary pressures in emerging markets will cast a shadow on global economic growth. One of the world's largest sovereign wealth funds, the Abu Dhabi Investment Authority, said in its first ever 2010 annual review. The fund expects economic growth to remain hesitant in the near term, but said it was confident the return on equity levels will jump back to 6 to 8%, according to Reuters. The statement made by the fund, which holds stakes in Citigroup or London's Gatwick Airport, are very much in favor of equity markets. Quote, assuming bond yields remain low and in the absence of major negative macro events, equities appear relatively attractive, even using conservative assumptions with regard to the equity risk premium. ADIA is heavily invested in North America and Europe, both accounted for about 60 to 85% of the fund's investments. Emerging markets constituted between 15 and 25%. Yesterday, it was the Abu Dhabi Department of Economic Development that tightened the cooperation with China. Today, officials from the DIFC signed an MOU with the Chinese. The Financial and Business Hub announced today that it has signed a memorandum of understanding with the Chinese Pudong Financial Services Bureau of Pudong New Area Government, a district of Shanghai in China. The MOU sets the frameworks of cooperation between the two parties to develop mutual financial service offerings. This MOU reinforces the economic ties between the UAE and China and encourages the financial and business exchanges between both economies, Abdullah Mohammed Al-Awar, the CEO of the DIFC authority, said. Staying with China, Etihad Rail has awarded a Chinese company the contract to supply it with cargo trains. The developer and operator of the UAE's national railway network appointed China South Locomotive and Rolling Stock Corporation to supply 240 covered wagons for the carriage of granulated sulfur in the western region of Abu Dhabi. Only recently, Etihad Rail also awarded the contracts for the railway sleepers and locomotives. The deal with China is therefore another important step forward to deliver the first stage of the railway network by the end of 2014. Construction on the network is scheduled to begin at the end of this year. Regional equity markets rose today on reports that Italy could get financial support from China. The Chinese are said to plan to invest into Italian government bonds. That pushed stocks higher. With that, let's now look at the main benchmarks across the GCC. World business news. Shares in France's largest listed banks, BNP Paribas and Société Générale, were hammered yet another day by worries about the impact of a possible Greek debt default. BNP Paribas fell nearly 20% since the close on Friday, and Société Générale nearly 10% on concerns about their liquidity and access to short-term funding. Traders added that doubts about a report that China would support Italy by buying its government bonds are weighing on BNP Paribas, given its large exposure to the country. But more so, talk of a full-on Greek default is on the rise. US President Barack Obama demanded decisive action from Eurozone leaders to solve its debt issues, as he fears the crisis spreading to Spain and Italy. While Obama urges the Eurozone leaders to act on its debt crisis, some forget that debt is not only a problem in Europe, also in Japan. Japanese Prime Minister Yoshihiko Noda reaffirmed in front of Parliament his commitment to curb public debt and warned taxes will have to rise. Cutting the public debt, which is twice the size of the $5 trillion economy, could not wait, and economic growth was necessary to salvage public finances creaking under the strain of a growing army of retirees. Noda, who is Japan's sixth premier in 5 years, also reiterated everything possible needed to be done to tame the yen's strength, which is hurting the country's export sector. The UK banks face a tough new set of reforms. One new regulation will be the separation of their operations. At the heart of the recommendations made by the Independent Commission on Banking, chaired by Sir John Vickers, is the separation of retail banking activities from investment banking through a so-called ring fence. That means the investment side of the bank would not be bailed out if it failed. Banks will also be required to hold between 17 and 20% of their capital in cash or assets in order to absorb losses. The measures, among the most conservative in the world, will be phased in by 2019. And they could cost UK banks up to £7 billion a year.
Improved financial stability does not come for free, but its costs are greatly outweighed by the gains of fewer crises, less damaging crises, and a healthier, more stable environment for investment in the UK economy.
Before we go, here's a quick overview of the oil, precious metals and currency markets, and after that we have the day's sports news for you.